Hi everyone, welcome to the weekly stock market update. Now I'm going to sound like a TV presenter when I say it is the best one yet. We've got more stocks than ever before, so let's get right into it. You're going to need a pen and paper, and you're probably going to need something to write on as well, because not everything will be presented again in the replay, okay? Because some of it's confidential proprietary information. Welcome one and all from all sorts of different parts of the world. Thank you, Martin, as well. I will try and answer all of these questions. Well, I will answer all these questions later. Bishop Stortford, Robert, Jeff, Barry, Martin, everyone, welcome one and all. Got a lot of people coming on. By the way, to save you a lot of trouble, I'm going to share a whole bunch of important links with you, which you can use for the end of the webinar. So I'm going to share those now. So hopefully that will pop up on your screen somewhere. I'm also going to share the copy of the book as well, which is this book. So you're going to have a copy of that, which is going to come through as well during the course of this webinar. So just keep an eye out for that. First things first, let's kick off with this. By the way, this weekend, I'm going to be in Dubai. So 9 a.m. local time near JBR. I'm going to host a open house. I'll put it on the Telegram channel probably tomorrow once I've worked out exactly where I'm going to be for Saturday morning, 9 a.m. If anybody wants to pop in, whether you're clients or whether you're not, and want to say hi, I'll work out the location for 9 a.m., just a 1 hour coffee shop, open house kind of thing. And hope to see you all there. Swansea, we have got represented. We've got loads of places represented. And clearly, I'm assuming you can all obviously see and hear me loud and clear. So let me share the screen and get on with it, because we've got more than ever before, more stocks, more names, more data, more analysis as well. So here we go, right into it. First things first, this is not individual advice to you. How could it be? I don't know you personally, so it's not individual stock advice. So please remember that as well as we go through this. Now, what are we going to cover? We're going to cover the rising stocks, the ones that I like, the ones that I don't like, but which are big names and other people seem to like, and a good process for doing these things. But also, what do we do with our cash? A simple flow chart for that. And equally importantly, a flow chart for, and it's only this bit that's important, what do we do with our stocks? In other words, when do we buy, when do we sell? How long do we hold on for? I'm going to answer those questions, try and keep it in simple terms, as you know, but also bring everything up to date for you as well. Now, this is a good one to remind you of. I've done this before in previous webinars, but it's a blooming good one to remind you of, I think. And the reason I think it's a good one to remind you of is because the markets, as you're about to see, are making stonking great highs. The one thing which might be worrying some people is valuations. This is 31 means you're paying $31 for every dollar of expected profits in Microsoft. And you might say, bloody hell, that's expensive, Alpesh. But of course, valuation is not the only thing which moves stock prices. Otherwise, ExxonMobil would be the one we'd all plow into, or Johnson & Johnson, Merck, Pfizer, AbbVie, Amgen, and not into, say, Amazon and Broadcom and Alphabet. Okay, so which are the cheap sectors? Those are they, but valuation is only one of many factors. So we're going to have a look at that. By the way, I'm going to try and do this as well. Over the next 7 days, these are the companies in the S&P 500 which have got earnings announcements coming out. So today, and this means after market close, this means before market open. Okay, so you've got these coming out. In case you hold any of these or you're thinking of buying them, you may want to be wary of the fact that, oh, they've got some earnings announcements, some big news items coming out. So we'll share that in future. Take a photo of this if you need, okay? And I'm going to do this in future as well. And this is difficult to see, I know, on the screen. So let me try and zoom in for you. It is showing for each sector the stocks, and I'll put this into Telegram as well. How do you get onto Telegram? It's in the document I've just sent you, which has links on it, important links, okay? Micron, NVIDIA, we'll put more names on in future of these, GE Aerospace, Organon. We'll look at some of these stocks just to see, have we missed any? I mean, given that they're going up so much, Should we be looking at them? Are we missing a trick? Is there something where they can still continue higher? And this is year to date, I should say, performance of some of these. But it also shows you which sectors are bounding ahead, and you can see the undervalued financials are almost all up. Technology still virtually all up as well. And we'll dive into some of these. Now, in future, you're going to have more detail on these. I'm going to put more names on in future for you each Wednesday and Friday. So don't worry, this is just to show you what's coming up in future for all of this. But we will then, in the course of those webinars, we'll go through some of that stuff so that you can see with some of the leaders, maybe even with some of the laggards. Okay. And I think that one's Tesla, by the way. We'll go into it. Some of the laggards, we'll see why they're underperforming. Remember, my approach when I talk about stocks, they will only be suitable for my portfolio. And actually, don't forget my son's junior ISA and my wife's SIP. If out of 10,000 companies I look through, I mean, what else would a husband and a father do for their wife and kid? 10,000 companies I go through, if they tick all of these boxes, and I've got the data, these first 5: value, growth, income, CROCI, cash return on capital invested, which comes from Goldman Sachs Wealth Management, Momentum, Sortino and Alpha come from the hedge fund industry. I'm not going to repeat myself on Sortino and Alpha. Essentially, what it means is they tend to stay up and not be too volatile and outperform. I mean, all the things you'd want in a stock. Well, wait a minute, Alpesh, what about narrative and stories and talk about AI and tech? I can cheat as well. I can just look at how price performance is. Well, the past doesn't mean that it'll be guaranteed to happen in the future. Nothing guarantees anything in the future. Speak to a physicist. Even gravity isn't guaranteed in the future. It's the nature of hypothesis. Okay, so we want all of those to be green just to make sure we haven't done something stupid. And you can see none of these stocks would be suitable for my dear wife and son. None of these would be suitable. Okay, so you can see the kind of due diligence that gets done. And that's the prism through which I'm going to be explaining everything to you in this webinar as well. Bognor, Regis, and Portugal. Keith is in Portugal. Dale is in Bognor. I don't know. Keith, I think we met in Spain, didn't we? I might be wrong. We've got beautiful Wiltshire as well. Welcome, everyone. Chinese retaliation tariffs incoming. Caterpillar. I'll try and have a look at Caterpillar later. I tend not to gamble on political news. I'll tell you why. Today, it was the Slovakian prime minister assassinated. Tomorrow, it might be somebody more important or some such important thing. So narratives I'm not gambling on. What I'm going to look at is resilient companies. Companies which, no matter how much you throw at them, tend to, but are not guaranteed to, be undervalued, high growth, good dividend yields, so that if the market falls and there's a headwind, they shouldn't fall as far. And if there's a tailwind and good times and there isn't negative news, then they soar. Okay, that's my purpose. That is the approach. Now, over the past week, you can see there's a hell of a lot of gold, a hell of a lot of green. And healthcare, some of the undervalued sectors did well. A splattering in the undervalued energies. Financials doing well. We'll look at a lot of these stocks that are coming up, okay, that I'm mentioning. And great, tech, semiconductors, telecom services, the ones we like, all in a bit of green. We'll also look at some of the ugly ones as well and why they're ugly and whether there's an opportunity in them when they haven't performed well. Exchange traded funds. I'm going to expand out the coverage of ETFs. And I think I might have started this week, I'll double check, where I'm going to look at some of the leveraged ones, which have been some of the ones which have provided me with the most returns. But I'm going to put charts into those during the course of these webinars. So we're always improving these webinars and thinking of ways to give more information in the same amount of time. Okay, markets year to date. Can you believe the UK is ahead? It's like Man City winning the Premiership. Unlikely, but won't happen again. S&P is up 10%. NASDAQ's up there. Dow's up there. For those who are clients of mine, don't forget, you can look at UK companies if you wish. We do the data. We do the filtering for those as well. It's a rare thing that it's ahead. And on the futures contracts, shorting the UK and going long the NASDAQ is a long-term positive bet. Because, I'm going to show you here, this is the more usual format. So how are we doing over the past 1 year? Well, the Nasdaq's up 37%, the Dow's up 27. The Dow is up 18, the S&P is up 27. Now, that's 12 months ago. We are in May. If I said to you from May of last year till May of this year, if you just track the Nasdaq, you're going to get a near 40% return in your pension, you would be very happy. Okay? A near 27% return in your pension, you'd be very happy, right? So, but look at also the correlations. They move in tandem now, partly because there's an overlap between the stocks which are in the Nasdaq, the S&P, and the Dow. Some are in all three. Okay. Now, what does that mean for us? Well, what it means is we're going to take a bottom-up approach. What we're not going to do is try and pick winning sectors and gamble on those, because who would have thought at the start of the year utilities were going to be the winning sector? We're going to pick companies which are good quality, tick all our boxes. So just by way of information, there you go. Communications, utilities, energy, financials, industrials are the ones driving the market. Oh, Alpesh, I thought it was technology because all the journalists keep talking about technology. Yeah, journalists love technology. That's their business. Okay. It's not actually technology which is driving the market forward. Okay. And I don't do a top down. So I'm not going to say to you, well, Alpesh, isn't the hypothesis whereby you could test that the lagging sector will be the one which will end up leading, etc. There's a lot of things you could test and hypothesize. I haven't tested them all, right? As you would expect, haven't tested them all at all. Now, what about the factors? Well, momentum's doing well. And we make sure we've got stocks which tick the momentum box and the value box and the growth box and the income. So when growth and value and momentum are at the top here, we should have enough stocks. You only need 20 in our portfolio, which tick all those boxes. Okay, so that's where we are at the moment. That's your FTSE 350, 350 largest UK companies, and they're the ones which are driving the UK market higher over the past month. That's their performance over the past month. We're going to come back to the US ones in a second. S&P 500, well, it's shrugged off that baby bear. That's a little baby bear. That's been completely shrugged off, and what we've been left with instead is a resumption upward to all-time highs. And what's happened is the monthly S&P has ruled the roost. I got a bit worried with the weekly falling. I shouldn't have been. I thought it was going to be like this. I shouldn't have worried. I took some of the massive profits we had, including on 3 times leverage S&P 500 since January of last year, and in Microsoft since January of last year, double leverage, not triple on Microsoft, and on sold half of Apple and Meta and Nvidia, and 2 times leverage Meta, because the returns had become from 100 to 200% plus, or well, in the case of Nvidia, far more. And it was just getting really heavy. That even a small percentage drop was meaning a large amount of money coming out of my son's junior ISA. But I needn't have worried. So how do you tell whether it's going to be a baby bear market like that, a mama bear like this, where it's a bit deeper, but you can either take money off the table or wait it through, or a daddy bear like this, where you just don't even want to wait, you just want to get into cash and stay out of the way? So is it going to be daddy, mummy, or baby bear for our Goldilocks portfolio? How do we decide? I'm going to come to that in a second. I've written a good article about it on my blog, and I'm going to share that with you. And also in the documents you've got, which says links, hopefully you can see that. That's on there as well. John, you must be a Man City fan. I'm from Leeds. Yeah, no, never happen again. Now, S&P 500. So it's all positive. It's all looking great again. Everybody's happy. There's a lot of miserable narrative stories that we're only going to get 1% a year for the next 10 years. I don't like narrative. I like data. Okay. So at the moment, that is good, right? You can see with the FTSE 100, that gradient is massive. If somebody went 3 times leverage on the FTSE 100 at the moment, exchange traded fund, I'd say to you, yeah, you're probably going to do all right. If you like that kind of risk appetite, you know, you could see that go up 10% and you'd make yourself 30% on a 3 times leverage FTSE 100. But leverage is risky. It is not to be done by any of you on here, because I don't know who you are. So it would be irresponsible of me to say, oh yeah, you should just go and do leverage. I don't know who you are. It could be 70-year-old orphans. I think most people are orphaned by the time they're 70, but you know what I mean. Now, that is looking stronger. Now, My concern, as I've constantly said about the FTSE is, and you might say I'm against it, is every time it does have those kind of, and it's up here, remember, this is where it is, it sort of runs out of steam pretty bloody quickly. In other words, something happens to cock it up. I'm not saying politicians, something happens to cock it up. By the way, the approach that I'm talking about here, I've been talking about, let me just stop the screen share for a second and share something with you. See that? That was published by the Financial Times in 1999, I think it was, or 98. Lots of lovely. So imagine that. It's now a quarter of a century since I've been discussing. Let's see, where do we get the focal point on this thing? I think that should be pretty good. We've got some great reviews from chairman of the London Financial Futures Exchange, the chairman of the Chicago Board of Trade, the managing director of Merrill Lynch UK, global head of derivatives at Banque Paribas, head of E-Trade UK, and we've got Equis, which is a Reuters company, also, amongst others, and a whole bunch of other reviews which carry on inside. The point I'm making to you is the approaches I'm talking about, and you can tell it's an old book, because that's what I used to look like. Ugh. Okay? Yes, I did look like that once. Well, not ugh, rather handsome young man. Ugh now. The point is, the approaches I'm talking about are not something that has just come up yesterday. The approaches, the way I'm using the everything that I'm teaching you, I've been using for a heck of a long time, and in exactly the same way, because it works. If it works, it works. Right? NASDAQ. Now, I've said it again. I'm going to sound like a broken bloody record. That is going upwards. Yes, fine. Except remember, you get drawdowns of a certain depth for a certain duration. Write this down. Drawdown danger equals depth times duration. Okay? So you look at a historical period where it was also rising, as it is now, and you ask yourself, well, what was the worst drawdown? Ooh, it was that. Okay. And what was the longest duration for it to break back to break even? 3 months. Depth and duration, we have to, in the hedge fund industry, show this to potential investors, whatever we're investing in, whatever the fund performance, you've got to say, well, this is our drawdown. This is how quickly we spring back. People want funds which spring back quickly. You know what that is when they can spring back quickly? High Sortino and high alpha. If you combine those two, that's what it effectively is doing. There isn't, I don't believe, a mathematical measure of that alone. You end up having to look at two different measures, and I'm sure the mathematicians here are going to say to me, just multiply them or add them, work it out. I mean, multiplicative would probably make more sense anyway, or do some kind of weighted addition. Anyway, the point is, always assume whenever you're going to buy something, so you might do NASDAQ 100 3 times leverage, okay, if you want, were that risk loving. Assume as soon as you buy it, it's going to do the worst of what it did in the last uptrend, which is it's going to drop that much and you're going to be out of pocket for that period. In the case of the NASDAQ 100, 3 months, and it's going to drop whatever percentage. Okay. And that might be worse on the triple leverage. So if you do just bear that in mind. Okay. I know I'm covering a lot. So I said I'd discuss some more of the individual stocks. So where are we on this? Now, you know why I got out of this, because when I got out of this about when I got out of Microsoft, whenever I said that was, what was it, 2 weeks ago? And the reason was I had so much in it. Now, of course, in hindsight, you say, you coward, you should have just stuck with it. And you're right, I could have and should have. But I wanted to get across to people, my son wanted a Ferrari, so I had to sell it. No, facetiously. Sarcastically, what I'm saying is, well, I had it since January 2023. You're not trying to be me. And this actually shows you what the problem with the fund management industry is. Imagine you get into a fund when it's at the peak and you think they're doing it for you. No, you've got in at the peak. You've got in at the wrong time. So if you buy this today, I'm not saying you're getting into that at the wrong time. What I'm saying is, if you got out at the same time as me, I got out for reasons that I was 2 times leveraged since January. We've made, what is that, from 7,000 to 20,000. Oh, 3-fold return. So you can imagine a tiny drop meant my son's junior ISA, my wife's SIP, was seeing tens of thousands come out of it. So I wanted to exit. Now you might say, why didn't you exit half? I could have done quarter. What I'm trying to teach people is to make their own decisions based on the knowledge I'm giving them, rather than, oh, I want to copy you. Tell me what to do. Well, actually, I said to you, I got out, but you could easily have held on. My worry of and why I got out was what I've just literally told you. And I said also the monthly stochastic, which is a good substitute for the weekly MACD. They're almost can read as the same, was dropping. The S&P weekly was dropping, and I just didn't want to take. I needed to take some money out. Okay, Amazon 2 times is still going strong. If somebody wanted to buy that today because they're risk loving, and you'd have to be risk loving, then you'd be looking at potentially a similar rise that it had before, which is what 5,000 to 8,000. Hell, 66% return. Yeah, you'll probably say, I'll take that, Alpesh. Yeah, I think on the 2 times leverage Amazon, there's a 66% return. But please bear in mind that in previous upward moves, you've had 1, 2, 3, 4 months, 5 months of no returns, and you've had drops of 40%, just like that. Okay, so bear that in mind. That's not for nobody on here should be doing that. That is the only blanket statement I can make because I don't know you, and leverage is risk. Okay, don't judge it by greed and how much you could make. Judge it by the heart attack you're going to have when the drawdown duration and depth is that. And if you think you're a risk 7, you're not. You're a 5 out of 10. Okay, so there's your Amazon. This is new that I've been doing these. Now, Apple, my son's still got 2 times average Amazon and Alphabet. I'm not sure if he's got Apple actually, because I sold half my Apple position. I'm not sure if he's still got Apple 2 times. He hasn't got Microsoft, I know that, and he hasn't got Meta, I know that, because those were the ones we sold 2 weeks ago to take some money off the table. But anyway, Apple is here. Looks like it might go back up. This looks positive, and you'd be looking at, what is that, from 16-ish to go to 20. That's 25% return. That's what leverage does. Does those massive, massive gains, but it's risky because look at that. Assume you're going to get the worst previous drawdown in an upward trend, which was that, and for months you were nowhere. Okay, right? You interpret the stochastic the same way as you interpret the MACD. In other words, near the top of the chart is overbought and likely to fall. Near the bottom is oversold and likely to rise. Okay, so think of this distance. Think of the bottom part as oversold, the top part as overbought, right? And consider the gradient as well. That's pretty important. No textbook other than mine. And by the way, that is one hell of a book. I mean, that's not light. Okay, it's one of 18. And by the way, that's pre-printed where it says international bestseller. I didn't write that on it because the Financial Times produced an international flipping bestseller. Thank you very much. Out of it. So the point is, I'm the only one who looks at the gradient. I've never seen anybody ever talk about the gradient. Gradient's a word which somebody recently, and I should know because I did maths at A-level, I called it rising steeply or sharply. I don't know why I didn't use the word gradient before. But anyway, it's so obvious and in front of my face. But one of my students used the word gradient. And I said, oh, God, that's the word. For 25 years, I hadn't used the word gradient. And that's what I should have used. Okay. Top 10 S&P 500 stocks. So let's dive into these. These were the top 10 performing over the last month. That's just momentum, though. We don't know if they're undervalued. We don't know if they're high growth or whatever. So let's look at those, because this is the extra stuff I'm doing in this. And then we're going to go through Apple, Amazon, Alphabet, Meta, Microsoft. We're going to go through those. So we've got a lot of information to cover in this. Okay, so let's go through these and see if any look good. Right, so that's Globe Life. No. Although it ticks a lot of the value growth income boxes, given the massive drop and the volatile resumption up and the falling MACD, it could never have passed all our boxes, because even before it collapsed, it was just too overbought. And this is what I worry about. Remember, when it's overbought, before it even fell, it's just overbought. Wouldn't do it. So I wouldn't even do it now. Okay. United Continental Airways, United Airlines. Well, I discussed it last week. The gradient's a bit weak. It's not oversold, it's not overbought, but it's a bit weak. But it does tick value growth income cash flow. I know the banks love it as well. How much aerospace? Overbought. Okay, It ticks our boxes of value growth income. It's an 8 out of 10. In other words, 7, 8, 9, or 10. It ticks value growth income, but overbought. I know these banks love it. It might be right in the future, but at the moment, I'm sorry, not for me. And Alpesh, have you missed the boat? Yeah, I missed the boat. I wish we'd seen it when it was here, when it was there, but that still would have looked overbought to us. Well, your system doesn't work then because you're not buying stuff which is overbought. You're right. But that's why we look through 10,000. There'll be loads that we don't do. Can you all still hear me? Okay, I just got a couple of pings on my computer, which made me worry as well. There is some data, Jeff, on Sell in May and Go Away, but it's a bit mixed, the data. The narrative is phenomenal. Everybody writes about it because journalists are bored. What else are they going to write about in May? Now, this company, value growth income, that's a bit, it's a bit shallow, the rise, and that doesn't fill me with confidence, although gaps do tend to get filled, so it should fill, but that's too risky for me, not for me. Moderna should gradually go up from an oversold position. It should do that. How many times have we seen stocks which look like they're going to do it, then all of a sudden they crap out, and it doesn't today meet our value growth income. However, if you'd already bought it when it did on the rising MACD, you'd keep hold of it. Okay, you don't trade your investments, you hold it for 12 months unless it drops 25% from the peak. AES does meet all our criteria, and it's rising. Okay, and the weekly is rising, which means it's going to have short-term and longer-term momentum. I'm not saying it's necessarily going to go there. I don't set profit targets because predicting one thing is hard enough, direction. Predicting 2 or 3, it'll go up within this time frame by this much. That's 3 predictions. No, thank you. One's hard enough. So I'm saying direction more likely than not upwards. Okay, Nextera, not for you. Sorry. Those on the program, you'll get that on the private Telegram channel later tonight. Teradyne, unfortunately, even though lots of things look good, and it's a bit expensive, and I think because it's expensive, it doesn't meet my value growth income. So not one for me. Costco doesn't meet value growth income, overbought anyway. So these are the S&P ones, which have done rather well. So now let's look at my quality 5, as it were, the ones that over the years have tended to consistently give ridiculously large returns for prolonged periods of time. Okay, they are Apple, Amazon, Alphabet, Meta, Microsoft. So let's have a look at some of those, shall we? All right. I'm going to just, for those who haven't seen it, just reshare the links document, and then I'm going to take it down because I'm going to share other stuff with you as well. So Apple, CVS, I'm not sure, Barish. I don't know whether it hit a stop and the team got out or whether it was a 30. I don't know. They know what the algorithm is and they know when to get out and all the rest of it. Apple, where are we on that? Well, I sold half, and you could argue, well, actually, you could have just hold on because look, it's had a V shape. You're right, but I wanted to take some cash out of it, and also the monthly MACD was falling. Now things look like they're going to be improving. Am I going to buy back into it? What day is it? Wednesday. I'll wait till Friday and have another look. I don't have necessarily a problem getting back in now how positive the S&P is. And would I get into 2 times leverage in it? Let's see on Friday. Amazon, well, I've already discussed the leverage position. I still hold this. So I still hold this from January of last year. Okay. And also in 2 times leverage of my son's junior ISA and my wife's SIP. Plus, I've got the underlying asset in my own SIP and ISA. So ridiculously large returns since then, and I continue holding it. I don't have a reason to sell it yet. The reason to sell would be if it drops X%, then I will sell Y%. What is that? Well, wait till Friday and decide. And Friday, I'll probably say I'll wait till Wednesday. So where are we on this? And incidentally, this also hits value growth income as well. Well, I've kept saying the same thing with Microsoft. It's a little bit overbought. That doesn't mean it can't go higher. 4 times out of 5, when it's at these levels, it tends to drop. Not as much as Daddy Bear, but it can drop. So it's a company which I know. You see, the thing with the quality fives, I know I'm going to get back in at some point. Why? Because they give me prolonged periods of very little drawdown and very large upside. And because they do that, and here we step aside in 2023, as you know, I ended up holding cash for most of that year for a very simple reason. I'll remind you again if you missed it. The monthly MACD fell below its own moving average. Simple as that. And I've written about it in there. I've written about it in there. I've written about it in probably all of the 18 books over my shoulder. But anyway, that's a separate issue. And I talk about it every single week anyway. But Microsoft, that's where it is at the moment. Would I dive in with 2 times leverage on it at the moment, which is an extreme way of saying, would I buy in right now? No, I'm okay. I've got quite a large equity exposure to the stock market already anyway, with everything else that I've got that's going on with, especially Amazon and Alphabet, that I don't need to do that. Okay. Don't forget YouTube. There's still a lot more to come. Don't forget YouTube, where I talk about all of these things. You can see it. Oh, where's he gone? Your channel. There it is. Woo! Hello. That's Sally. And you'll see on the YouTube channel, you'll see a load of stuff. But you'll also see why your pension's performing poorly and all of that. So please do have a look at that. Now, Netflix, which, as you know, I didn't get into. We've been covering since it had those phenomenal results there. It's getting more and more overbought, but you would do the same rule. If it drops X, sell Y. Look, it did drop and then it came back, and maybe it'll make all-time highs. But start getting cautious because of the rise. You know, yes, it might spend 2 years going sideways, but you're not going to hold it for a 0% return for 2 years just because you think it might just give you a little bit more there, are you? All right. Walmart, value growth income. Now it's hit it this week. So it's ticked all those boxes, but it's overbought. So not one for me, and the weekly's falling as well. Simple as that. Okay. If in doubt, leave it out. That's my rule. Tesla, still falling over there. So not at the moment a special situation. I don't think it ever hit value growth income because the numbers are just never going to be good enough. We had it as a special situation, which means rising MACD, and it hit some of the green boxes in January of last year until I got out in October of last year when the momentum came off. And then, of course, it's been falling since. I wouldn't get it now. MasterCard, overbought. As you know, I sold out of it after 12-month period was up. I think it was slightly longer than 12 months, but after it was up. And in any event, it's slightly overbought, so I wouldn't have it today. But it will be one which I'm sure in the future I will come back to. It's not as reliable as you can see as an Amazon or a Microsoft or an Apple. And one day, maybe there'll be other companies which will be in the magic 5 or whatever. But it's less reliable than those because, look, it spends bloody years doing nothing for your money. And on top of that, slaps you with the credit card, which does nothing for your money because you just use it to sell. I know all these banks are positive, but as I've written in my Financial Times columns in the past, with data, they're over-optimistic. Analysts in banks, Procter & Gamble, and NVIDIA, which you're all into. Look, it's the same thing I've been saying for bloody ages, which is if it drops X, sell Y, and you determine it Y on your own risk appetite, okay? You determine it on your risk appetite. Simple as that. Now, Alpesh, what about some kind of future narrative and navel gazing and crystal ball gazing or time machining? No, don't need to do any of that. Okay, so where are we? Berkshire Hathaway. I'm not even going to interpret this because you all know how to do it. Put in the chat box whatever your interpretation is. But let me answer some questions before I move on to more stocks. Aaron asks, have you considered any small amount of your investments to look extreme edge cases like GameStop? I have at times, Aaron, and it's a fantastic question. And I used to trade penny stocks when I was in my late 20s. So indeed, yes, I have considered it. But you've got to allow for the fact I'm older, and at my age, with a 6-year-old son, I don't want to mess things up, and time is ever more precious because there's. I'm mindful I've got very little of it left. So yes, but you'd have to put it in a different category. Overbought based on John, you're absolutely right, John. Your analysis. Disney has dropped X. Is it time for me to sell my Y? Depends what your Y is. Depends what your Y is. For me, I'm going by the MACD hasn't crossed below its own moving average, so I'm fine with Disney. I wouldn't get out this early. I wouldn't. US election year effect. Yeah, it tends to be positive, but bloody hell, has there ever been a US election like this? You're going to have a president from prison, I think, possibly. It's really funny. So America goes around. I mean, I'm a big American fan. I worked in the U.S. Congress. I read U.S. politics. I lobbied the White House and the State Department when I was working for Congressman Eliot Engel in the mid-90s. It was the most important work I'd ever done in my life, et cetera, et cetera. I'm a big fan of the United States, the U.S. Constitution, all the rest of it. The irony is it lectures the world on political interference. And of course, you've got one of the two main presidential candidates being hounded for criminality. But the presumption is, oh, that's fair due process. They do it in any other country. And of course, it isn't. And it probably isn't in any other country. And it probably is in America due process and arm's length. It just doesn't smell and look like it. You couldn't make this stuff up, could you? What if you bought Disney after earnings call drop, but it's continuing to drop? Well, it depends why did you buy it? I don't know why you bought it. Whatever your strategy and hypothesis was, it's up to you. I bought it when value growth income were what they were, and my exit is 25% from the high, or MACD say drops below its own monthly moving average. That's it. If you bought it for different reasons, it's entirely up to you, whatever your reasons were. You might have bought it because you like their new, I don't know, subscription service. You've got to have a hypothesis and stick to it, not just be speculating blindly. For me, it was very simple. Value growth income and the momentum looked to be rising. Then it's a 12-month hold. And it's the same thing that I say each week. This is it. Look, it's there. Okay. Has it been 12 months? Has it dropped 25% from the peak? Or have you become risk averse because the MACD has fallen below its own moving average on the monthly side? Okay, for instance. Or because you've made so much money that even a small drop, like in Microsoft, panics you out. If it's not those, I mean, you've got to have the reasons why you got in, value, growth, income, cash flow, Sortina, and the reasons for exiting. Can't keep mixing out and saying, well, I got in because it dropped a lot. All right, have you tested that hypothesis? Nah, just thought I'd throw it around. Well, welcome to Vegas. Okay, I'm going to come back to some more of these. Eli Lilly. Now, this is one which I'm kicking myself, actually, because I think whenever we had it, and I can't remember when we had it, I think the return we got on it was really pathetic. It was like 10% in a year or something, really low. And if you look at it, it means we must have picked one of the few windows where it hasn't shot through. And it's one of those which, I wish I had treated with more respect and got in over there, but you can't have them all. And I never saw it rising as much as it has, going up 100% in such a short space of time. Even though previously it ticked so many of our boxes, I guess I ignored it. Whatever, there's 10,000 stocks, you can't get them all. But anyway, overbought now. Walt Disney, I'll do it on the private channel. Give you a clue, I'm still holding it. Okay, for the simple reason the MACD, well, it hasn't fallen from the peak to trigger a sell, and the MACD hasn't fallen below its own moving average on the monthly. So simple as that. I don't then overthink it. I wanted to show you this. This is a daddy bear. This is a mummy bear, and this is a baby bear. Okay, how do you tell the difference between these? Now, I'm going to tell you very quickly, right? So you don't panic. And it's the same with stocks as it is with indices. A daddy bear where you want to go into cash, i.e. a big, massive, fat drop, is when the monthly MACD from a high level drops below its own moving average. Okay, whatever the hell happens, get the heck out of there, because daddy bear's coming in. Mummy bear is one where you could ride it out, but I wouldn't have the balls really to do it. I wouldn't go totally into cash, but I might take off 10, 20, 30% of my stock positions and hold more cash. How do you tell? Well, the monthly MACD falls, but doesn't go beneath its own moving average, but it falls. It's falling. Okay, that's mummy bear. So what the hell's baby bear? Baby bear is one of those which you should ignore. Sometimes you might not, like I didn't. I just took some money off because we'd had such a bloody gain in Microsoft and Amazon, all the rest of it. It was just getting too much exposure to very small moves. Were taking too much gain away from me, so we eased back on it. But interestingly enough, I subsequently find out Warren Buffett sold 13% of Apple, and he said, I continue loving it. Tim Cook was in the audience, and he said, it's just that, gains or whatever. Anyway, so what's a mummy bear? Mummy bear, simple. The MACD doesn't even fall. All right. So what do they all have in common? All of those bears, the weekly MACD falls, they all have that in common. So that doesn't differentiate them. It just tells you it's a bear. What differentiates daddy? Daddy is where the monthly crosses. Mummy is where it's just falling. And baby is where it doesn't even fall. Simple as that. Okay. I've covered it in a very quick way. Hi, it sounds like you have more sell candidates than buys. Are you higher in cash than typical? Only 3 weeks ago, but I need to start deploying that capital again. So 3 weeks ago, as you know, and as I said, I sold quite a few more. Do have a look at my LinkedIn as well. Let me answer some more questions. If you are trading it, then as a stop low, or if you're trading, then presumably you've got some kind of trading strategy, I assume. Oh, that's Paresh. Hi, Paresh. Okay, now, don't forget this. Oh, I've got to share with you the book. We haven't finished yet. I've got to share with you the Investing Unplugged book. That should be coming through on your link now on your site somewhere. Okay. I also want to do a poll and ask you, for instance, do you think, and let's share the results of this while I answer more questions and go through more material. This is the thing that we're trying to avoid, this underperformance of fund managers. Somebody said to me, Alpesh, I'd been beaten down to think that as long as I get more than a bank account, so if I get 4 to 5% per annum, that's what my IFA told me, I should be happy. And I'm like, you bloody kidding me? And I'm going to show you something now on that. This is what people had wrongly been told. And I'm going to do more. So we've covered pretty much everything I hope people wanted to see. I mean, I come more, but I've got a lot more to cover with you as well. And I said to him, I said, why were you told that when you can see that actually there's only two things you've got to do? You've got to be in a position to be in and not be scared off when the markets are rising, because they will have sharp drawdowns. Look, that's the S&P 500. They will have sharp drawdowns. Look at the historic drawdown and upward move, and it'll tell you straight away drawdown depth and duration. And okay, how do you avoid the deep moves down? The example I always give students is this, and this is why fund managers are institutionally going to let you down, because institutionally, and this is meta, and it's a great example, when this falls, and I'm not saying you're going to get peak to trough fall, you're going to get precise entry and exit. When this falls 76%, they've got to keep holding equities, and equities are correlated to the downside more than they are when markets are moving up. So they'll give you some BS about, oh, give it a longer period of time. And then your IFA, who honestly is mathematically incompetent, will say, well, there, you see, buy and hold works. Over 2 years, that was 2 years, 3 months, you went back to 0%. You didn't lose anything, did you? So you only lose money if you sell, and you didn't lose 60%, 70% there and 6 years of your pension at all. Yes, but why did we get in January 2023, this and many other stocks, as you will know, because you can look on my Telegram and YouTube? Well, because they were on value growth income and the MACD was no longer falling. Momentum was no longer falling. We got blocked out of buying anything because even if they're value growth income, as you've seen this evening, if the momentum is falling, I won't buy them. I'm sorry, I won't do it. And you might say, you're supposed to be good. You're supposed to tell us stocks which can defy gravity and go up even in a falling market. Well, I tell you what, when Mark Zuckerberg invents that company, or Bill Gates invents that company, or Sergey Brin, co-founder of Alphabet or Google, invents that company, or Elon Musk does, I'll do it. And if they can't invent the company which goes up when everything's falling, then they bloody expect me to suddenly find that company. Doesn't even exist, hasn't been built. And we're looking at 10,000 companies. And we, like a cheap tart, can pick anything. He really can. Okay. Of those. So what happened over those 2 years? Well, your fund manager got 0% over 2 years and crowed about it. So look at what geniuses were. In a rising market, our stocks actually went up. That's what they'll say to you. And the IFA goes, see, I told you. The IFA is like a fund manager's pimp. Okay, they will say any old crap. As long as they're getting money, they will say whatever you want to hear. You know, if you say, can I call you Jenny? They'll say, yeah, call me Jenny. Big bloke, IFA, Brian, he will say, call me Jenny, anything you want. All right, for money, they'll do it. But the truth is, over those 2 years, we got that 100% plus, 170%. I didn't know it was going to go up 170%. Otherwise, I would have gone to Ladbrokes. So if you didn't know it was going to go up that much, how did you stay in for so long? I told you, simple rule. Either it drops 25% or the MACD drops below its moving average. Bloody hell, look at that. I'll let you into another secret. If the weekly and monthly are rising like that and value growth income boxes are ticked, yes, you're probably going to get a pretty strong rise up. It's not guaranteed. Nothing's guaranteed in the markets. If ever anything was guaranteed in the markets, I'd be a bloody trillionaire. Okay, so I'm trying to get people away from muppets like these who are saying to you, oh no, trust us. We've got a fund and that fund can go up. I mean, how many more newspaper articles do you want that the wealth management industry for the masses doesn't work? It might work on the Goldman Sachs end because I've stolen what they do. They use cash return on capital invested and a hell of a lot more sophisticated advice. Okay. So what do you think? FTSE, 55% of you think it's going to be higher from today's levels. Let's reset that and ask you what you think about the Dow. And we'll publish the results then. Okay. But not only that, you get IFAs. I'm not kidding. I had an IFA on Twitter defending pension fund manager Blue Whale. And that was 2022. And they were down 27.6%. Scottish Mortgage Investment Trust was down 50%. And the IFA said, yeah, but you got a hold for a longer period, didn't you? Well, I'm sorry, I just don't like losing money unlike them. Hi, Alpesh, I'm thinking about if I can get from a pension. Is there any rules against sharing the information with my kids? Not wife and kids, that's fine. As in, yes, you can with wife and kids. We don't. In fact, I invite families, if they've got the time and energy, to come on, on the calls with me. But also, I sort of show parents how they should get their kids eased into it, because you don't want to put them off, and you don't want them sitting at a lecture from Uncle Alpesh either. But there are ways of getting them baby stepped in. And, if you're like me, the best thing you can leave your kids is either money or education. And if you can leverage both money and education, you are absolutely laughing. This is the biggest problem we get. This is Legal and General, okay, as one of the employer SIPs. And check your employer SIPs. Please check your employer SIPs. 20% growth. I say this every week because it needs to be said. She could get 5% interest. That was over 10 years. 20% growth in 10 years, because basically all they did, as so many employer SIPs do, is generated what the market index tracker would have done over the same period, and a little bit less, because they do a bit less because of the fees. Okay, why? Well, imagine if they tracked the NASDAQ. Bloody hell, she would have had 100K become 482,000 and thought, well, I might be looking at retiring now. You don't want that in the workforce, do you? So I wonder if employers are purposely picking crappy little employment pension funds. I don't actually think that that's what's happening as a conspiracy, but it's turning out that way, and turning out quite nice that people are working longer. I can tell you something. If those were the returns that people had in their pensions, I'll tell you what's going to happen if that happened. Mass. You got a whole load of people watching me and doing some of the stuff I'm saying. You're going to get the government raiding your pensions. And by the way, it's going to happen sooner or later, because it happens in every banana republic. They raid the pensions in every Eastern European economy, because that's where the trillions are. How do you get hold of the trillions? Raid the pensions. You're going to read and hear more and more about how they're going to raid pensions, secretly, backdoor, eventually just nationalize all private pensions. I don't know when. I hate to be a conspiracy theorist about it. I don't have any evidence they're going to do it, other than every Eastern European country and banana republic does it. Okay, so it's coming to a country near you very soon. That's the first thing. The other thing is, if you have that kind of stuff, not only are they going to tax you, but they're going to start saying, well, what do you mean you're retiring? What the hell are you doing retiring? How come there's so many of you in the Virgin upper class buggering off to the Maldives in your 50s and 60s? What the hell's going on? We need you in the workforce. Oh, crap, because we're not reproducing as much as we were. And we're certainly closing borders. So one way or another, they're going to have to tax the crap out of pensions. And it's the last hidden bastion of shitloads of money. Think about it. In every country, it's where it is. You spent a lifetime working for it. And they nationalized. We had, in our hedge fund, one of the investors was Aegon. Okay. And the arm of Aegon was out of Romania. And the Romanian government changed and they nationalized it. I mean, it didn't impact ours because we had the money in our fund. I mean, they were under contract. They couldn't do anything. But they nationalized the freaking pension. And that meant our client was no longer Aegon. It was actually the Romanian government. Sorry, Hungarian, not Romanian. Hungarian, to get it right. Hungarian, apologies, Hungarian. As I thought, bloody hell, this stuff can happen. Anyway, so what kind of returns are realistic? And 40% seems ridiculous until you see that Meta, Alphabet, Amazon, all the rest of it. Well, forget that for a second. You can only do it under these circumstances. You can't do it every year. Please understand that in 2022, we barely got above 0% return. Why? Because when the markets fall, everything falls and we had to hold cash. Well, Alpesh, why didn't you go into inverse? Why didn't you short the market? Well, because that's trading. It's not investing. Yes, the short trades I showed on my LinkedIn and stuff, but I can't include that in my investing. It's not investing. It's trading. It's like saying, oh, yeah, well, I went to Vegas that year because I had a lot of time in my hands. I'm going to include that in my retirement thing. No, it's bloody Vegas. Okay. It's high Sortino, high alpha. In other words, high average returns, low downside risk. That's Sortino. Incredibly important in the hedge fund industry. Why IFAs don't even know what the hell it means? God save me. Okay. Even fund managers are idiots. And I'll tell you how you can tell if your IFA is an idiot and your fund manager is an idiot and prehistoric and that they've learned this stuff in the 60s. See if they use the Sharpe ratio or the Sortino. Now, what's the difference? The average reward a stock provides you, the average return, right, versus the downside risk of missing it is the Sortino, because the downside risk of missing it is the only thing you care about. Treating the upside risk, i.e. overachieving and downside, and calling that volatility, that's the Sharpe ratio, which is a bit freaking thick, isn't it? So initially, that's what was invented. And somebody clever in the 80s said, well, surely we only care about the downside risk. If it overachieves to the upside like NVIDIA, sure, we want that. So they wouldn't pick stocks like NVIDIA because they'd say, hi, it's got a low Sharpe ratio, too much volatility. Yeah, to the bloody upside, you muppet. See if they give you fund data and it says Sharpe on it. Guaranteed they will, because they learnt their stuff from the 60s and 70s textbooks. And when they got educated in the 80s, they were still using those old textbooks. All right, and so how you tell. And you can Google Sortino and Sharpe, and you can see why the hedge fund industry uses Sortino and why the muppets in the IFA industry use Sharpe ratio. They're idiots. They're literally sifting out companies which are overachieving because they have too much upside return and volatility. They keep bumping up to the upside too much. And, oh, no, we don't want that, Grandma. Don't want to make too much money, do you? In a perverse way, it's the most British thing in the world. Okay, Hayden's laughing. Death and taxes, I know. So how do you protect against government for stealing your pension? DM, spend as much of it as possible and give it away to your kids and wife. I don't know. I do not know, because I can't say hide it under your mattress, but I don't know if that's a separate thing. You know, become prime minister and make sure you don't do it and screw the people. US only, because it's given me 10,000 stocks. It's not going to be emerging markets to give me that 40. If you can go into cash in a bad year like 2022, that's going to be incredibly important. And how did we do it? Well, monthly MACD was falling below its moving average. Did you just pull that out of the thin air, Alpesh? No. 20 years ago, I told you. 25 years, quarter of a century ago, I told nobody reads books anymore. So you won't be reading this one, but it's in there as well. How do I know it's in there? I could probably even show you the page where it's in there, where I go through it in great detail. I kid you not, I did all of it. There you go. Look, you can see some of the charts. Yeah, you can see some of the charts there. Don't take my word for it. Paresh, I think, is on here, aren't you, Paresh? Paresh devised all the strategies for a hedge fund called Marble Bar Asset Management, which went to 4 billion. Similar kind of stuff to me. That's why we're kindred spirits. If you monitor once a fortnight, see my Telegram, okay, on that. So you got to monitor. You can't just have something go all the way up and then all the way down. So, oh, I thought I'd just wait 12 months. No, you got to pocket some of those profits if it falls off. Good years have to make up for the bad, like 2021 is good. 2023 is good. Got to make up for 2022. Croaky, you want to tick that box. That's Goldman Sachs' data. And I'll tell you that. That's 30% returns from stocks just in the top croaky ones. Paresh is there. Thanks for the e-chat. Well, he was a floor trader on Life, and he worked for David Kite, who was, well, he's in the rich list, David Kite. He was a floor trader who I interviewed for my book, Mind of a Trader, and Paresh was working with him, and they co-founded the hedge fund, which, as I said, went up to 4 billion. But he devised all their strategies, which I'm going to tell you a secret, okay? And people underestimate this. Every single one of the strategies that was the basis of that fund is in the book he and I co-wrote called 7 Simple Strategies. I've got it in there somewhere. Anyway, it's in the book. People go, oh my God, he's given the Coca-Cola recipe. No, the Coca-Cola recipe, as Paresh will tell you, is how the hell do you raise 4 billion When I crack that, I'll let you know. Okay, that's the Coca-Cola recipe. How the hell do you not? Oh, I've got a recipe. Grandma's got a recipe. She's not bloody selling Coca-Cola. She might be selling Coke, but she's not selling Coca-Cola. If you hold for 12 months, then you reevaluate. Sell anything which drops. So you got to have some kind of drop rule. I mean, 25% is the general one, but you might make it 30% if historically the same stock on its way up tends to drop 30 all the time. Then you might say, well, make it 30. Okay. Last year was phenomenal. It might never happen again. The S&P was up 25%. That's why we did amazingly well last year. It was our stocks from the further filtered final list with the MACD rising, the quality 5 and the special situations, January to December. Okay, remember, it wasn't a typical year, might never happen again. So don't expect me to keep doing the kind of return I'm about to show you. 2022, we got nothing, for instance. Okay, but last year made up for it because it gave it 80.3%. Those were the stocks. Well, wait a minute. How come they've not got consistent performance? Well, ask Warren Buffett why not, because he has a similar thing. You get some which are down in the same year using the same bloody process, and he's been using his process longer than I've used mine because he's older than me, twice as old as me. And yet you got two. Why couldn't you just pick ones which went up 100% plus? Yeah, I wish. This doesn't happen. Even though you use, like Warren Buffett, the same processes. I don't use his process, but I'm saying use the same processes. So just wanted to make that point to people. I want to talk about this guy. He just died. Okay, absolute bloody legend. They made $100 billion at 39% per annum return after fees since he set it up. He's the most successful hedge fund manager of all time, the most successful fund manager of all time. Don't worry, I'm not getting teary-eyed. I have no opinion on any stocks. The computer has its opinions and we slavishly follow them. I love that statement. That's it. In many ways, whenever I have an opinion on a stock and I say, oh, I like this one, tends to be rubbish. Okay. The computer, all I say is computer likes it and it tends to do well. All right. Equally, look at this. Oh, I really like Tapestry, guys. I really like Perrion Networks. But that was down 1.68%. That was only up 22%. You're rubbish. Yeah, I'm going to use this phrase from now on. I have no opinion on any stocks the computer has, because that's exactly what he did. And that's how they got $100 billion. Jim, absolute. I mean, you know, people say legend. The guy cracked the market. There's a book where it says the man who cracked the market. Yeah, I wish I knew what the formula was that he used, but I hope there was a lot of overlap between what I'm doing and him. I hope. He also knew how to raise shitloads of money, which helps if you're American. Never bet against America. Yeah, you could. There's a Jim Simon somewhere in Iraq, in Afghanistan, in Syria. There's probably one in Palestine right now. They're not going to get anywhere. They're not going to get anywhere. And there's one in Iran. They're not going to get anywhere. There's one in America. He's going to be this big. I'm not even saying anything that's insightful, just stating the freaking obvious. And you might blame America for that either way, but I'm not saying anything on that either. So those were the ones. That's our approach. We just do that. If you plan to invest over 20 years, you make 20% per annum. You can't do it like a bank account. It's not going to happen every year. You have 100K in your 401k, add that, then you should be making $1 million over 10 years. That's the goal, $1 million over 10 years. Okay, turn 100 into $1 million, 10 into 100. That's the idea. Now, the way it'll happen is you won't get 20% a year because it's not a bloody bank account. I wish it was. It'll go like this. That's what will happen. It'll do this because that is the nature of the beast. Okay. The most important thing you can do, people say, oh, you can start early. Well, what? Have you got a bloody time machine? Of course you can't start early. You haven't got a time machine. You can only start now. All right. Whether now is early or not, well, depends on your health, I guess. It might be very bloody late for all I know. You might have a day to go, or it might be 100 years to go. The point is, the easiest thing you can do is improve your performance, because mathematically what we've seen is elongating your time investment frame or adding more money is not as effective as improving your performance by 1%. Improving your performance by 1% is a hell of a lot easier than forgoing every single expenditure to start investing for an awfully long period of time. Okay, and that's what these charts show. Improved performance. Can we do it? Yeah. That was me, 2004. That's what led me to set up the hedge fund, because with my big mouth, I kept talking about it, that it can be done, because I wrote that many books published by the Financial Times. They themselves said, right then, big boy, Let's put you in a competition with a cat, with a bunch of fund managers, with the greatest fund manager history has ever known, said the Financial Times, the Warren Buffett of the United Kingdom, some geezer called Neil Woodford. They said he is incredible. We and all the press love him, and we really do our due diligence on fund managers, they said. So anyway, he was out by 50% of what was going to happen with the market, and that was in 2004. They still loved him for another... why is my brain frozen? 12 years. 13 years. My brain is totally frozen. 13 years. I gave him 9.2 billion, and he really did incredibly well with that lovely chiseled face. I don't know which prison he's in at the moment. Anyway, I won that. That's not the only thing I've won. There were various others. So opening SIPs is really easy. Those who've not done it, I had a solicitor who emailed me and said, where should I start? I said, open a SIP. Whether it's Barclays or any of these brokers, check them out, look at their fees. Best thing to do is ask them, I want to buy, I don't know, £1,000 worth of or £10,000 worth of XYZ stock. How much is it going to cost? All right. Get them to work it out. Don't you try and work it out. It's like trying to work out your tax return. Don't go for name recognition like Scottish Mortgage Investment Trust or anything by St. James's Place, for God's sake, because the evidence and the data and the history and the heritage is all against you. 3 people now out of their 900,000 clients have emailed me to say they've had a good experience. 3 people out of 900,000. The 800,000 others have said, no, they're rubbish. But 3 have. I think, to be honest, I think 2 of those 3 made it up just because they wanted to be different. Value growth, income, cash flow, Sortino, Alpha, it's your pension. It's up to you. If you're not looking at 10,000 stocks, you're not narrowing it down with an approach which is very systematic and methodical. That are the undervalued stocks which are growing, which aren't overbought, etc., 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 then you're gambling. The less information you look at, the more you are gambling. All right, so don't gamble. And then your exit is different to your entry. Your exit is, well, let's hope they are bloody overvalued and stink, and because they've risen so much, they're about to collapse, and let's get out before they do. There's your exit. Or are you risk averse? I've told you the MACD rules on that one. I've done that year in, year out. Usually people have about 20 stocks. Don't go over 40 because you're a bureaucratic nightmare. The fund managers will pick up 100. You pick up 10 fund managers and you've got 1,000 stocks. Absolutely waste of time, waste of money, and guaranteed to underperform statistically, mathematically, and in every single other way. Okay, yeah, it was Jim Simons. It was Jim Simons. Did I not say that? Sorry, it was Jim Simons. Okay, that's who it was. You're absolutely correct as well. Now, that you don't need to worry about. Like, oh, there's the book. There's the book. Parish, I show it every week. We launched the book with mine, the one that Parish and I co-authored, and he put all the hedge fund strategies in at Barclays. 7 simple strategies of highly effective traders. That was it. There's the book. And so, bloody hell, I've been talking about it every single week. I didn't realize. I've written a whole load of others. I think we've co-authored 2, Paresh. Online Trading Cookbook, which also has the strategies in there, and the other one. This is not a promo for buying books. I think I've sent across. Yeah, I've sent across the Investing Unplugged book, so you should have that there as well. Okay. What I want to show you is these are the portfolios at the moment of Bill Gates, Warren Buffett, and Goldman Sachs. You don't need to buy these or copy these. What I want to show you is this. They've got less than 3% of their money in their 8th largest holding. In other words, it's concentrated. Put all your eggs in one basket, watch the basket, as long as you've got the data and the know-how, which obviously they have. Else, if you find any fund manager which doesn't have that level of concentration, or IFA who doesn't want you to do that level of concentration, I don't mean these stocks. If he say, no, you don't want those American technology companies, you don't want those American companies, you don't want to be that, you know they're an idiot. Because if they don't have the wherewithal to manage and keep an eye on it the way a Warren Buffett or Bill Gates does, then they don't have that wherewithal. So why the hell are you giving them their money? You know, I've got a little old man sitting at the corner of St. John's Wood Tube Station who you can give the money to. Okay, right? Because if they say, oh no, that's bad, don't tell them it's Warren Buffett's portfolio. Say, I'm thinking of buying these, and these are the percentages I'm thinking of putting in. Obviously, don't just copy this portfolio, but I'm saying, and see what they say. And if they go, that'd be rubbish, you're a bloody idiot, send it to your IFA. They'll say that. So you're an idiot. You should actually give it to St. James's Place instead. They'll do better than Warren Buffett. right? You'll know that they're deceitful, fraudulent, and absolutely idiotic. This is the Goldman Sachs slide about Croaky, cash return on capital invested. What it means is how much capital has the company invested, how much cash is it producing. Companies in the top 25% by cash return on capital invested generate 30% per annum in share price returns. Not every company in that basket and not every year, but we need to tick that box because 30% is not something I can ignore. All right, I'm not guaranteed it. The past does not guarantee the future, but it is a pretty good guide. Okay, these are the typical portfolios we get, which have so many holes in them, and they overbuy too many funds. They're over diversified. It's spray and pray, and they've got piss poor performance time and again. Again, there you go. 1,000 different companies, scattergun effect. I get a lot of emails about people telling me what's happening. This is in the case of Brewing Dolphin as well. Okay, so like I said, that's the holy grail. That's what we use. That's the way I do it. Investing is like learning to drive. Okay, imagine it's like learning to drive. Nobody ever says, "Oh, leave that to the professionals. You should leave driving to. You shouldn't do that. You should leave it to the professionals." No, they say, "Get me a bloody driving instructor. I want to learn," and that's it. Naomi joined me at the age of 21 from university, worked for me for 2 years, and then joined Newton, and then she joined Polar Capital. It's like learning to drive. I taught her how to drive. She was actually my secretary and taught her the rudiments. Her and there was another lady, Kirsty, who went on to become a pensions solicitor. And we showed them the rudiments and said, come back a week later and tell us which stocks you like. And both of them did. And we said, right, there you go. You can do it. It's pretty bloody easy. It really isn't as difficult as people make out, as long as you've got the data and a bit of the knowledge, and that's it. I've been doing it for a long time, ever since I had hair. That's how long I've been doing it, ever since I had hair. That's a long time. Okay, so there we are. Anyway, if you want us to access, now I tell you what I want to do now in my later years, and I talk about it on the news and all the rest of it, is I want to make St. James's Place go bust. I've decided that is it. Because I think institutionally, it is a marker for how poor performance has become the norm. Thanks to them, they're a FTSE 100 company with 900,000 clients. I want all of their clients. It's as simple as that. I want all of their clients to be empowered by the data themselves and be taught how to do it. So they only need to spend 5 minutes every 2 weeks to look at their pension, make sure nothing's dropped by a requisite amount, and then leave it alone. The ones who keep looking at it every day are going to give themselves a heart attack anyway. We had so much positive kind. As you know, we decided to launch exactly that. Give the data and give the education to people. That is what I call the Great Investments Program. And I want to get, it used to be 250 people on. I think we can handle 300. Before, for those first 300, it'll always be me teaching them. It'll always be me mentoring them. Then when it goes beyond that, obviously there's a limit to what I can do. We'll have others, but you'd still be in that first 300. Initially, it was going to be 250, but I can still manage it as well. You should have a book signing day. Paresh can do that. Okay. Yeah, Paresh can do that as well. You can do the book signing day. I've done too many of those. They're great, but I'm all right now. So what we did with the program, the way we launched it is we said, well, for the first 300 to prove this works, and we think it really works well now, and to perfect it with the first 250, 300, is give them lifetime updates, give them a one-off charge for access for life. Obviously in future, different. We'll probably get venture capital investment at some stage and hopefully float it and become a FTSE 100 company like St. James's Place, knock them out of the place, take all their clients off them. Simple as that. That's the goal, the new goal, because they're one of the 100 largest UK companies and they're one of the most shorted stocks. In other words, the institutions all think they're going to crash and burn as well. Okay. And give them all of this. And what did they want? They wanted two things. They wanted the data and they wanted the tutorials from me. There's a whole online education thing I've done. They don't want that. They want the tutorials with me. So think of me like your driving instructor. This is the way I describe it to people. You set up as John Smith Family Office, and I'm presenting the Excel spreadsheet and the PowerPoint executive summary as if you're the Prime Minister and saying, right, this is the PowerPoint of the stocks. This is the data. And you say, well, okay, where's the data? I say, it's in the Excel. You go, okay, I want to understand Alpesh. I say, okay, let me explain to you. Then you've learned you're the chairman of your own investment company. That's it. I mean, you don't have to have a company as such. It's your SIP or your ISA. That's the goal. And I formulated like that because I realized that's actually what people want. That's actually what they're doing. They want the control, the transparency, the data, and the knowledge, and then they just want to look at it once every 2 weeks to make sure it's fine. But they're in charge. It's whichever broker they use, their SIP, their ISA, not some Muppet IFA saying when the market's crashing, keep buying these funds, keep buying these funds. No. Because as we've seen, fund managers can lose 6 years of your pension in 1 year. 2022. That year was 2022. Okay. 20% return on a 500K SIP, well, that's 100K. So we try to pick something which was a no-brainer. On a 100K account, 20%, that'll be 20,000 you'd make. Anyway, that's it. I'm going to answer some questions. Do have a look. We've got a wonderful series of testimonials and the like. Okay, I'm going to answer questions about giving Warren Buffett portfolio to your IFA and say you want to buy that. Yeah, I think that's a good idea, isn't it? We can do that. We should probably do a giveaway for the books at some stage, Paresh, where, I don't know, each webinar, actually, that's a good idea. Each webinar, we pick somebody who's been, I don't know, really good or come up with a great idea or something, and we give them a signed copy of the book so that we've got a reason for somebody to come onto the webinars and contribute and be attentive. I think that could be a good idea. By the way, you go there if you want to sign up and we want us to do it all, but you don't have to because you get my webinars anyway. We also worked out what do we provide that others don't, and that's what it was. We ticked more boxes than anybody else. It was as simple as that. Have I missed any questions? If I have, please let me know, and I will answer them either now or later. Please have a look at Campaign for $1 Million as well. I'm going to send you a couple of files as well. You're going to leave. I'm actually going to send you all the files. You should get all the files, the links, the Investing Unplugged book as well. Okay. And what I want to do, and in the links, you'll see you can have a tour of everything with Paresh. Paresh, you should put your email address in because he'll give you a tour of everything in more detail. You can arrange that on a calendar with him. If any of you, I don't think anybody on here will be from Dubai, but I'm going to be there, as I say, Saturday morning, and I'm going to do that as well. Okay. Now, one of the things that I want to discuss here is, because some people have missed this, and I did a whole load of videos yesterday that I've posted online. If you go to alpeshpatel.com/shares, that's our performance 2021. 2022, as I said, was barely above zero because the market had fallen. 2023, you saw the 80% thing. Do you see these? Even if you've not signed up, you can watch these. Please watch these because they actually teach you a hell of a lot. And yesterday I put up some more ones, like how long do 50% returns deliver nothing? So eventually you end up with 50%, but for how long do you get nothing? Okay, so all of these are just previews. You don't even need to sign up. So please go to alpeshpatel.com/shares and have a look at that. Is there a limit on brokers have access to specific stocks? Yeah, there is. Some brokers like Best Investor, rubbish. They'll talk about how cheap they are, but they can only offer you 3 stocks. Hargreaves has a pretty good diverse range. Interactive Brokers as well. Interactive Investor does as well. So they all have a pretty good range. Do I have a preference of what I use? I don't end up using the cheapest, sadly. What I tend to do, and I've done this from my Financial Times days, is I look at a lot of brokers because I want to commentate on all of them, a bit like Martin Lewis would. And so what I do is I use Hargreaves, AJ Bell, IG, Interactive Brokers, which I don't particularly like because the platform's rubbish, but they are one of the cheapest, actually. And there's Interactive. Free Trade I've got as well, which are okay. It's very app-based. It's very cell phone. And I'm getting to the age where actually I quite like to log in, not look on the app. And the reason it's very phone-based is because they're trying to get you to trade. They make money if you trade. Don't trade. We're looking to invest. They don't like it when you invest at all. Okay. What did I want to show you? Yeah, and what else? There was something else. Yeah, don't forget on my YouTube channel, which is on alpeshpatel.com/links, you've got a whole bunch of videos on going through tons of pensions and encouraging you to do pension reviews. Yeah, I mean, you can always ask them to get the list. I mean, the worst thing I've seen is people open an account with the brokerage and then discover they can barely buy or sell anything. Okay, it's really awful. And quite a few brokers are, like I said, Best Invest. I was really surprised at how rubbish they were at that. And I wouldn't touch them. Vanguard, for instance, will only buy and sell their own stuff pretty much, which makes them pretty useless as well. And it's partly trickery. They just don't want you going elsewhere. Okay, people, I'm going to send me any other questions, or to Parish. Did you put your email address? Yes, you did. To Parish. And I'm going to go enjoy the sunshine. Everybody who signed up, thank you. You're going to get an email from me onboarding you in a second. Prices are going to go up again, I'm afraid. And you can imagine why they're going to go up, because obviously with the markets doing incredibly well. I joked last year, we've indexed it with the market. And of course, the NASDAQ went up 55%. And I think from start to end of the year, so did our fees. They went up 55%. I'm not saying it's going to be the same again, but it's going to, the markets are at all-time highs. People are making lots of money. It's unfair that, and we're hiring more people to do more data, more analysis, more graphics. So I think it's only fair on that front. But you'll continue getting all this free stuff anyway. You'll continue getting all this free stuff all the time anyway. So don't worry about that. Okay. Now I am going to get going in that case. I'm going to just check if there are any more questions. And if not, then I'm going to say bye-bye. Thank you all very much. I hope you did enjoy it. And if you did, I'm going to leave you with a link. If you wouldn't mind leaving a testimonial just to say thanks. If you enjoyed it, I'm going to type my comment if I can. Here's the testimonial thing. If you wouldn't mind, that would be phenomenal. Keeps the SEO going, or whatever they call it. But yeah, that'd be great. There's the link on there. Thank you all very much. I am going to find you all. There you are. And I'm going to sort of do a little wave goodbye. You've got the Investing Unplugged book on your screen. It should have come through on the webinar as well. So you should have that. I think I've got to flip the screen on this, don't I, to make that look the right way up. But you should have that as well. So thank you all very much. And thanks for your patience on here. Really appreciate it. And I will say goodbye, and I'll come up with more stuff on the Telegram channel, so keep an eye out. And then Friday or Saturday I'll do the update, because obviously I'm flying out, so I'll do it on either the Friday or the Saturday. One of those 2 days I will do the next update for you, and I'll upload this on YouTube, and on they'll put links on Telegram and everywhere else for you all as well.